Inflation, inflation, inflation. On the program today, we're going to talk about some of the things that you can do as a consumer to help beat inflation. And then, of course, we'll need to talk about some of the things that you can do as an investor to help beat inflation. Along with that, on the program, I'm going to be joined by one of our fellow certified financial fiduciaries, who happens to also be an IRS enrolled agent, Christina Lamb. We're going to be talking about the top five tax misconceptions on the program. So as always, chock-a-block full here on Dollars and Cents. We welcome you to the program that helps you make sense out of all of life's decisions involving your dollars. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So certainly not to ignore the current headlines, but we spent a lot of time on last week's program talking about Russia, Ukraine, and what the long-term foreign policy and investment implications are on that. If you're curious about our thoughts and views on that, well, then you'll have to go to your favorite podcast channel of choice to check out the information that we talked about last week on the program. Clearly, those headlines continue to dominate and led to some volatility in the markets. We saw once again this past week some seesaw action, if you will, which of course is quite common for these kind of headline events. We continue to believe, though, that the bigger issues longer term economically are things like inflation and interest rates. So we thought it would be important to sort of refresh everybody's mind about that other headline behind the main headlines. In case you missed it last week, inflation was reported by the Commerce Department, although I don't know how you could miss this one, because if you go to a gas station or go to the grocery store, it's pretty much staring you in the face at every item that you look at. But anyway, last week, inflation reported by the Commerce Department at 6.1% on an annual basis, year-over-year rise. That is the highest since 1982. So quite a number of years since we've seen inflation run at that high of a level. So that begs the question, right? What can you do? So we're going to talk about on the program ways that you as a consumer, just practical, good old-fashioned common sense advice that you as a consumer can try and follow to help those dollars go further and combat inflation. And then we'll also be talking about what you as an investor can do to combat inflation. So let's begin, shall we? So in no particular order, these are just some of the traditional ways that you can fight inflation on the consumer side. And it starts with just being brave enough to ask for a better deal. I think sometimes we always think that a lot of things price-wise aren't negotiable. They are. And so the worst thing that can happen is if you ask for a better deal, a better price, is that somebody says no, right? I mean, you're not going to ask for a better price and then they're going to raise the price. That isn't really kind of how it works. So no harm in certainly asking for that. Also thinking about asking for, okay, well, are there any programs or are there any discounts or are there any coupons or anything like that that might help to lower the cost of this good or service? Maybe I'm a member of a particular organization and then that comes with a discount. Make sure, particularly in an inflationary environment, that you're taking advantage of those things to help those costs stay in check. Your APR, your annual percentage rate, the interest rate that your credit card company charges you, those are often at least available or at least open to a conversation. So no harm in even calling the credit card company and saying, hey, can you cut me a little bit better rate than what I am currently at? Or maybe you could just do that for a season, for a 12-month or 24-month period of time. So again, in order to try and beat inflation more on the consumer side, don't be afraid to ask for that better deal, or maybe see if there's a program or a deal or a coupon out there that helps to reduce those costs. Number two, and I guess this one is appropriate for March. So this one has to deal with looking at your recurring expenses, right? So it's March, and maybe you're not using that gym membership quite as much as you were in January. So perhaps take a look at that and see whether you're still using that. In today's world, so many things that we have are based upon recurring memberships, right? It's our Netflix, it's our Apple, the list is just enormous. And it's easy to overlook some of the subscriptions that we just automate and that are just getting charged each and every month. So make sure that you take a moment to review kind of those ongoing recurring expenses, and is there a way to reduce them or eliminate them? Obviously, the easy ones are things like your internet bill or your cell phone bill or your phone bill, assuming that you still have that phone at the house and you haven't cut the cord, so to speak. I know when we did that, I was very hesitant to cut the cord. I'd had that phone number for forever and decided ultimately to do it and have not looked back. Did that about 3 years ago. But again, those are the kinds of things that you can look at. Recurring expenses. How do I shave some off of that? How do I eliminate something that I'm not using? Great way to help combat inflation, to help those dollars go stronger. Similarly, as we would say, now is probably a good time to maybe postpone those big ticket purchases. And obviously we think about that in terms of how well things like the market is doing, how well the economy is doing. Obviously, if things are weaker, if the market's not behaving as well as we like it to, then good time to say, okay, is this really something that I need to have now? Can I delay it? And frankly, in today's world, it probably makes sense to delay some of these bigger ticket items, particularly if you're thinking about cars or trucks or boats. I mean, we all know what's going on there is the prices have gone up quite a bit because supply has been so constrained. So it certainly would make sense to put that off. There's also some seasonality, right? A boat in December is always going to be cheaper than a boat in May, because in May you have the whole boating season in front of you, and in December you don't. So there's definitely some seasonality things to think about as well. We're going to take a break. When we get back from the break, we're going to continue this conversation about how you can better combat inflation from a consumer perspective. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. On the program, we're talking about ways in which you as a consumer can help slay the inflation dragon, if you will. In today's world, we've sort of forgotten about inflation, particularly after a 10-year period where it was incredibly low. It didn't really shift that much, but now it's staring us dramatically in the face. The Commerce Department reported week before last that we had the highest annual rate of inflation at 6.1%, highest since 1982. So on the program, we thought it would be good to talk a little bit about how you as a consumer can help combat inflation. We're also going to dig into how you as an investor can help combat inflation, but we're focusing on the consumer first. So welcome to the program. This is, of course, Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a variety of radio stations throughout the Central Florida region. My name is Joel Garris certified financial planner, certified financial fiduciary at Nelson Financial Planning. So if you missed what we were talking about in the first part, we'll just recap quickly those first 3 items of ways in which you as a consumer can combat inflation. Number 1, always ask for a better deal. Don't be afraid to ask. What's the worst they can do? Say no. Ask for a better deal. Look for a coupon, promotion, discount program, things like that. Number 2, examine those recurring expenses. Do you really still need the gym membership in March, or has that kind of tailed off? Take a look at all of those things that we pay for every single month that are automated, that hit our credit card, hit our checking account, that maybe we don't use as much. Number 3, postpone big ticket purchases. I guess that sort of makes sense, right? Particularly with what's going on with cars and trucks and boats these days. I might want to postpone that purchase given that all of those prices are up pretty dramatically. Number 4, when you go to the grocery store, good old-fashioned shopping list. Now, obviously, in today's world, you don't need to take a piece of paper and a pen and write it down. You can put it on your phone. Regardless, it still counts as a shopping list. And when you do that with a shopping list, when you go to the grocery store, then you're buying what you need rather than what you want. Always good to stock up on durable items, particularly when they're on sale. Buy those in bulk, but be careful about the stuff that can spoil quickly. I think too often, I don't know about your house, but at our house, it seems like I'm throwing away stuff that we bought and then we didn't use, and then it kind of got rotted out. So be careful of that. Make sure you're using a list when you go to the grocery store. Great way to help combat inflation. Similarly, when you think of the notion of buying versus renting, if you buy, particularly in today's world, then you're able to get a fixed interest rate. Now, the problem, of course, with real estate here in Central Florida is the prices have gone up pretty good, so you've got that working against you. But the reality is, if you rent, oftentimes what you see is those inflationary rent increases come to you. So that rent is going to be much more subject to inflation than if you purchase, particularly now. Interest rates at very low levels. Yes, they're above a little bit where they were, but on a historical basis, those interest rates are at incredibly low levels. So consider buying rather than renting, because renting does have the potential to be increased as a result of inflation, whereby buying, once you've got a fixed rate mortgage, you've got a fixed rate mortgage. That payment is not going to change for the next 30 years. Number 6, be more energy efficient. I guess especially now with gas prices the way that they are. Maybe plan those trips, plan those errands so that you're not going out of your way, or you're not going out every single day. Instead of driving to the corner coffee shop, maybe walk to the corner coffee shop, and maybe it's just walk around the block and don't stop at the coffee shop because that coffee's probably overpriced. Turn off the lights, right? Very simple stuff, right? When you leave the room, shut the lights off. That's a good way to be more energy efficient and help beat inflation. And then, of course, watch that AC unit, right? Here in Florida, if you don't have one of those programmable thermostats, you can easily forget, leave the house, leave the AC on for 2-3 hours. If there's nobody there, that's wasting money on your energy bill. So certainly a great way to combat inflation, particularly when it comes to gas prices, is to just be more energy efficient. Walk or drive versus drive, or maybe plan those errands to get more together. And then lastly, and this I think is true in any environment, whether it's inflationary or not, you want to follow a budget. Track those expenses. It's easier to do that now than it ever used to be because of the phones that we have. I mean, we're basically walking around with what effectively was a supercomputer 30 years ago in our pockets. So you can make a list, you can track those expenses, you can follow it, and ultimately help to see how that money is getting spent to make sure that you're not wasting it. Importantly, know the difference between those needs versus wants. There's a big difference, and now would be the time to focus on the needs and not necessarily as much on the wants. So those are some of the tips that we would have for consumers in terms of how to battle inflation. So we'll shift gears and talk about some of the things that investors can do to help combat inflation. And some of these are some of the good old-fashioned normal strategies that all investors should follow. Certainly the first one is, and that is diversify, right? That's a time-honored practice of making sure that you own different things in your investment account. Simply put, different things that you own from an investment perspective perform differently at different points in time, right? So what that means is that you've got an opportunity with a diversified portfolio. Hey, maybe something is doing a bit better than inflation versus others that might be getting more impacted by inflation in a portfolio. Number two, rebalance. We've talked about that at length over the years on this program. Make sure that you are rebalancing regularly your portfolio, trimming out the winners, so to speak, and banking some of that profit. Always a good time to do that, though, when things are calm. You don't really want to do that in the middle of chaos or dramatic headlines, because if you do, then fear is going to be the emotion that drives it and ultimately causes you to overreact on that rebalance. Number three, focus your portfolio on large companies with long histories. The reality is that if you've got a business that's a pretty good sized business, they're probably a leader in their field, much more easy for them to pass inflationary increases along to the consumers. Because if you think about large companies that have unique products with some barriers to entry, then certainly that gives them the advantage, right? If Amazon, for example, is not all of a sudden going to be able, or a competitor to Amazon is not all of a sudden going to be able to deliver products to everybody's doorstep within a few hours. Amazon clearly has a lead and a unique product with a significant barrier to entry. It's not like you can just get in there with a truck and be like, okay, I'm going to deliver goods to everybody on the planet. The reality is, though, that makes it easy for them to increase their membership fee, right? So those are the kinds of companies to look at from an investment perspective, because certainly those larger companies, particularly those that sort of have a sizable market share, maybe have a unique product with some big barrier to entry, that at the end of the day is able to better combat inflation. And then lastly, to steer clear of traditional bonds. Traditional bonds, if you will, longer term bonds in an inflationary environment, wind up not performing as well. Those bond yields have a hard time keeping up with inflation, especially when it's coming in at 6 or 7%. So those are some of the things as an investor that you need to be aware of in terms of how you can combat inflation. So some good information there. Hopefully you all found that good and useful to help fight inflation. When we come back, we're going to have more good, useful information. We're going to be joined by Christina Lamb, an IRS enrolled agent at Nelson Financial Planning, to talk about the top 5 tax misconceptions. Coming up next here on Dollars and Cents. On the program, we're talking about the top 5 tax misconceptions, some of those things that people think that they know about their tax return, and then the reality is it doesn't really work that way. So we're pleased to welcome our fellow certified financial fiduciary, who happens to also be an IRS enrolled agent, Christina Lamb, back to the program. How are you this morning?
Doing good. Thanks for having me, Joel.
Awesome. Good stuff. Well, you deal with this on a regular basis, obviously part of our tax department, and we see a lot of common misconceptions out there, don't we?
Yes, we certainly do. This list was actually created by myself and our fellow CFFs who take incoming calls on a day-to-day basis here at Nelson Financial Planning.
So good stuff. So let's get started. What do we got that's on the list?
So our first item was the graduated tax bracket system. There seems to be a misconception in general about how your taxes are calculated. A lot of people think, oh, I'm in the 12% tax bracket, so everything is taxed at 12%. Well, that is not in fact the case. There is a tiered system starting at 10% and going to 37%, where there's segments of income that each bracket of your income is taxed at. So for example, that first 10% tax bracket is up to $10,000 and change for single filers and $20,000 and change for joint filers. So that first set of income is taxed at a much lower rate. And then if you make over those amounts, so up to $41,000 for single filers and $83,000 and change for joint filers, that portion of your income is taxed at 12%. So as you go through the tiers, each little segment is taxed differently. And the biggest jump, most interestingly, is from the 12% bracket to the 22% bracket, which is a 10% increase, pretty much affecting most of the middle class,
Sure,
I would say.
Because that break, if you will, if we think about the standard deduction, because these are all taxable income numbers that determine which tax bracket you're kind of falling in for that income. Mm-hmm. For married couples, usually about around 100 grand.
Yep.
So if you're above that, then you immediately wind up starting to get hit with the 22%. But that's a great example, because a lot of people think that if I get into that bracket, then I just triggered a big problem.
Yeah, right. Everything is taxed at that.
And that's certainly not the case. It's not some cliff that if you fall over it, you're going to go straight into the bottom, if you will. It's just the piece that is over that, and that's the piece that becomes important to know sort of how that works, because that leads to a lot of some of the internal analysis that we do at the office in terms of how that plays out for people and what's a good tax efficient decision versus not. And I think you've got a couple of examples of that.
Yeah, so sort of the one kind of leading into what you just discussed was, for example, let's say you're in the 24% tax bracket and you're going to be withdrawing some extra money and also possibly retiring that year. Now, if you take a large withdrawal to, say, pay off for your cars, maybe your house, whatever the case may be, as you're moving into that retirement stage of your life, the year that you're still working, if you take that extra money too, that may bump you up into an even higher tax bracket. So the suggestion would be just wait until the following year once you have retired, and then go ahead and take that redemption. So that would give you possibly an 8 to 10% savings on that redemption tax-wise if you just held off and did a little tax planning and waited a minute to take that redemption.
Right, and look to spread that out over a few years,
or possibly spread it out. Yes, very true.
Oftentimes we'll run into conversations of folks that maybe they've got their mortgage somewhat paid down to a lower level, and they want to just kind of clean it up and be done with that sort of remaining balance. And that's a great example of where it may make better sense to sort of split it up. Maybe do some now, and then come January of next year, because that's a new tax year, of course, to be able to grab some money at that point to maybe complete what you were trying to ultimately affect. Also, another thing to look at, and this obviously comes up an awful lot in today's world, is the notion of Roth conversions, and do I convert my IRA to a Roth, and how does that ripple through my tax return? Those are that's why it's so important to kind of understand that graduated schedule that we're on, because ultimately then you could be filling up that pretty much all that 22 or into the 24, whereby traditionally you might be at the 12% bracket, if you will.
Oh, exactly. I actually have an example on one of our other misconceptions that goes over just that, in fact. So then that's certainly one of the biggest misconceptions. I think you were sharing with me earlier. Tax withholding is another one. Correct.
So what's the big misconception on how tax withholding works?
This is the prepaid plan, which never is really truly prepaid. So when you have tax withholding, whether it be on IRA withdrawals or arbitrary amounts set on pensions, things of that nature, they're generally focused on just that account. So when somebody says, oh, here's your Social Security, it's X amount of dollars, you're like, oh, just withhold 10%. Well, that's just that Social Security portion. As you add up all your different baskets of income for, say, Social Security, pension, maybe IRA accounts, whatever the case may be, all that's going to aggregate to a much larger amount and then fall back to that tier system that we discussed, where the lower amount is 10% to 12%, 22%, and so on. So just because you pick 10% on your Social Security or an IRA withdrawal doesn't mean that tax withholding was sufficient for the withdrawal itself. All that will be rectified when you do your tax return. Now, that portion that you had, the IRS kind of holds, and it goes towards your tax liability, so it's not, forgotten or misused. You still get credit for it. It just may not be sufficient for your tax liability.
And I think one of the biggest areas where we often run into that is when folks sort of take money out of their 401k or whatever that aren't age eligible, and when they dial these 100 lines, and the folks on the other end will typically tell them, oh, you're not old enough, so there's going to be a 10% penalty. And then people say, all right, well, that's fine, just withhold the 10%. But you still owe the tax.
Yeah, that's only the penalty.
The number of times, and I'm sure you've had it numerous times as well, that people are like, oh, hey, I got, they told me that withhold 10% taxes, and then that would cover it. And that only covers the penalty. That doesn't cover the taxes.
Yes,
so
great point.
You really have to kind of understand how all of that ripples through on your tax return, which goes back to point number one, which is understanding the bracket.
Correct.
Because if you're going to take extra money out, that's all going to be at that highest marginal bracket that you are at, not some lower number. So some good points there. What about, I guess, the common misconception? It's funny on this one. I actually was just exchanging some emails with someone about not quite understanding the difference that taxes play on different types of accounts.
Right. So there is a difference between taxation on IRA accounts and non-retirement accounts. So first off, to understand, IRA accounts are pre-tax money, meaning that you have never ever paid taxes on this money. So IRA, 401k, plans like that you have through work, those are all going to fall into that category. And the other type of accounts is non-retirement accounts. Those accounts are after-tax monies, and those monies you've paid taxes on. Let's say you sold your house and you had a chunk of money and you invested that. Those would be after-tax monies. So the difference between these two is IRAs are taxed at ordinary income, and that's fully taxable to you.
Every dollar.
Every single dollar. Every little
itty
bitty penny. Yes.
Right.
And those are taxed at ordinary income, which goes back to that graduated tax scale. Whereas the non-retirement assets are taxed at the capital gains rate, which actually receive special taxation. So there is a tiered system specifically just for the capital gains. So on those type of accounts, you're only paying on the gain because all that money that you put in was after-tax money.
And there's a big difference in terms of the tax rates, income tax rates versus qualified dividends, long-term capital gains. We'll hit that when we come back here on Dollars and Cents. So stay with us through the break. We're talking about some of the biggest tax misconceptions that folks have here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning. It's tax time, so a great opportunity to talk about some of the most common misconceptions that Americans have when it comes to your taxes. Joining me on the program this morning is our fellow certified financial fiduciary, also happens to be an IRS enrolled agent at Nelson Financial Planning, Christina Lamb. Welcome again back to the program. So just to recap, for those that missed the last segment, we were kind of hitting the first couple of common misconceptions. What are those in a nutshell?
So the first one was the graduated tax bracket scale, meaning all your income is not taxed at the highest rate that fell into your schedule. There's a tiered system as you go through it. The next one was tax withholding. Just because you have an amount held on a transaction does not mean that it was sufficient for your tax circumstance, because we look at, when you do your taxes, you look at everything in an aggregate, not just one little piece.
And then we were talking about the difference between sort of IRA, 401k accounts, and the regular investment accounts. And we were just getting before the break to sort of that difference in tax rate. So one is taxed differently than the other.
Correct. So we were saying IRAs are taxed at your ordinary income, and 100% of IRA withdrawals or 401k pensions are all taxable at that ordinary income rate, which goes back to that tiered system. And then capital gains are just specifically the gains on non-retirement accounts. So, it's not the money that you put in, it's the money that you made. Those are taxed at the special capital gains rate. And that also has a tiered system. But the good thing about that, there is actually a 0% tax bracket. So for single filers, if your income is under $41,000 and change and you have capital gains, those capital gains will not be taxable to you.
Which is a pretty valuable aspect of how all that plays. And again, how that corresponds is if you're in the 12% or lower income tax bracket, then it's got to be long-term capital gain. Your short-term is ordinary income, but long-term capital gain and qualified dividend, not just any old dividend, but it's got to be a qualified dividend. So it's got to be a company that's paying out a dividend, and you have to have owned it for a certain period of time and things like that. So those two types of income are taxed at that lower 0% rate if you're in that 12 or lower income tax rate, which again, in terms of adjusted gross income, about $50,000 if you're a single person, about $100,000 if you're a couple. So those rules sort of drive a lot of where people should be getting their income from as well.
Correct. That's absolutely true. So the next bracket to the capital gain system is the 15% tax bracket or capital gains rate. So that's where majority of people may fall on their capital gains. And then there is also a 20% tax bracket, but that's for capital gains, which is over $460,000 for single filers and $517 for joint. So that's really high. But back to the 15% tax bracket, that's where most filers are going to see their capital gains taxed at, which is still a better rate than your ordinary income rate, considering where you would be in that bracket.
15% is still a better tax rate than 22.
Exactly. So as advisors, we use those brackets to determine, where may be the best place to take, your money from. One example that kind of goes back to what Joel was saying earlier in the program, I had a client in my office who normally didn't do their tax return with a paid preparer, started doing some pre-tax planning with us, and we realized that they had about $12,000 in free income that they could take out of their IRA because they used the standard deduction, and they had money to basically give on their taxes.
Wow.
So they took $12,000 out of their IRA and still paid absolutely no taxes.
Great example of how important it is to integrate tax planning and really your actual tax return. It's one thing to kind of do some tax planning with a piece of paper on the back of an envelope. It's a whole nother thing when you're actually running it through the software and seeing exactly how that plays out on the tax return. So some interesting stuff. Good segue into sort of the next common misconception, right?
Correct. So that's the standard deduction versus itemizing on your tax return. So I personally feel that there's been a very big faux pas over the years of my practice in taxes against the standard deduction. As if somehow you are maximizing your tax return. But
there has to be something more that I can do to lower
to make
my
it
taxes.
better. It just has to be.
Just taking what the government is giving me. That just sounds like, it's never going to work out.
Exactly. But starting in 2018, there was big changes made to the standard deduction, which made it pretty much, I wouldn't say impossible, but pretty rare for most people. I would say prior to that, we were probably 50-50 standard deduction, itemized deduction on our tax clients. And now it's more like, 15% itemizing.
I think nationwide, it's down to about 7% in terms of itemized deductions. So very, very few people are able to itemize now because of how big those standard deductions are. And a lot of people wound up getting a little shorted with that, because if you think back to the rules prior to that larger standard deduction. There used to be a personal exemption,
Yep.
and then you could do the personal exemption and the itemized, come out pretty far ahead. But with the elimination of the personal exemption, then the whole game, if you will, changed. Almost a tax increase for some folks that nobody really described as a tax increase.
Yeah.
Yeah.
Basically.
Yeah.
Yes. Mm-hmm.
So, and then the itemized deductions are still, there's still a threshold and things like that, because it's an either or, right? You're either getting the standard deduction or you're
Correct.
getting the itemized. So,
Correct.
what are some of the things that people could put on their itemized deductions?
Right. So the way that works is your itemized deductions have to be greater than the standard deduction. So itemized deductions include property taxes, mortgage interest, charity. Now it also includes medical, but medical has a threshold of 7.5% of your adjusted gross income. So all of that has to be greater than your standard deduction to make that count.
And the important key piece on that medical deduction threshold is you got to get above the 7.5%, but that doesn't mean that everything below the 7.5% threshold now becomes a deduction. That's never going to be deduction. It's only
Correct.
the amount
The
in
overage.
excess.
Yes,
Yeah,
that's
so
correct.
it limits people. So so those are the issues to be thinking about of itemized versus standard. What's the last one on your list?
So the last one is my personal pet peeve, and it's do not compare your tax situation to anyone else's or your neighbor's. So for example, Johnny next door, he's your buddy, he's retired just like you, he has Social Security and a pension, swears, he always gets a refund, and you're like, why don't I get a refund? Well, you just don't know. He could be withholding taxes somewhere. He could be itemizing. There's a lot of different scenarios that could be coming into play there. So, you just don't want to compare your situation because as people describe it, it doesn't necessarily mean they're exactly the same.
Every situation when it comes to a tax return is truly unique.
It very much is. Very much is.
No question. Everybody's situation is certainly unique, combined with the fact that a refund isn't necessarily a good thing.
Right, and that's another thing, absolutely. A refund is not getting a special prize from the government. You didn't get something extra in most circumstances. It means that you've paid too much in along the year and they're holding your money.
It's a free loan. Anyway, we're going to wrap it on up and get on out of here. Thank you for joining us again on the program. Good stuff. That's it for now here on Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning.